Aradel just reported one of the strongest quarterly results on the Nigerian Exchange. Revenue exploded. Earnings nearly doubled. Cash flow surged. Net asset value climbed sharply. Yet, after reviewing the numbers, I still ended up with a hold rating. So, what exactly am I seeing that the headline figures don't reveal? Let's go behind the numbers. Welcome to Behind the Numbers TV, where we break down financial statements in plain English so that both new and experienced investors can understand what is really happening inside a business. Today, we're analyzing Aradel Holdings' first quarter 2026 results. By the end of this video, you'll understand what drove the company's explosive growth, why some of the profit numbers deserve closer scrutiny, whether the dividend remains safe, and most importantly, whether the stock still offers attractive value at $1,750 per share. If you find this useful, hit the subscribe button and the notification bell. We do this every reporting season. Let's get into the numbers. Let's begin. Aradel Holdings is an energy company involved in crude oil production, natural gas production, petroleum product sales, and strategic energy investments. The investment case for Aradel has always been straightforward. Acquire quality energy assets, increase production, generate more cash flow, and turn that growth into higher earnings for shareholders. For several years, management has executed that strategy remarkably well. And the first quarter results suggest that those acquisitions are now showing up in a very big way. Let's start with revenue. Revenue is simply the total amount of money a company generates from its business activities before expenses are deducted. In the first quarter of 2025, Aradel generated $199.9 billion in revenue. In the first quarter of 2026, that figure surged to $728.5 billion. Take a look at the numbers. That represents growth of approximately 264.5%. For every $100 Aradel generated a year ago, it is now generating roughly $364. That's extraordinary growth by any standard. The acquisitions completed in 2025 are clearly contributing significantly to sales. But here's where experienced investors start asking a different question. If revenue is growing this quickly, are profits growing just as efficiently? And that's where things become more interesting.
Let's look beneath the headline numbers. At first glance, the profit numbers look strong, but there are two developments investors should pay close attention to. The first is margin pressure. A margin measures how much profit a company keeps from every naira of revenue. Aradel's gross margin fell from 39.5% to 35.2%. That means the company is keeping less profit from each naira of sales than it did a year ago. Now look at cost growth. Revenue went up plus 264%. Cost of sales increased by plus 290%. And administrative expenses went up plus 479%. Notice what's happening? Revenue is growing rapidly, but costs are growing even faster. Cost of sales increased faster than revenue. Administrative expenses increased almost twice as fast as revenue. This is one of the most important findings in the entire report, because if costs continue rising faster than sales, future profitability can eventually come under pressure, even if revenue continues growing. And then we arrive at perhaps the biggest issue in the quarter: earnings quality. A significant portion of reported operating profit came from a line called Other Income. Other Income contributed 208.9 billion naira during the quarter. Without that contribution, core operating profit would have been approximately 164 billion naira, rather than the reported 373 billion naira. That's a very big difference. Why does this matter? Because investors generally place a higher value on profits generated directly from a company's core business than profits generated from one-off events, investment gains, foreign exchange gains, or accounting adjustments. This doesn't mean the profits are fake. Far from it. It simply means investors need to monitor whether these earnings remain sustainable over the long term. Now, let's look at one of the most important metrics for shareholders: EPS.
EPS stands for earnings per share. This tells us how much profit belongs to each individual share. In quarter 1 of 2025, EPS was 7.77 naira. This increased to 15.24 naira in quarter 1 of 2026. That's a growth of approximately 96%. In other words, the earnings attributable to each share almost doubled within a year. Historically, share prices tend to follow EPS growth over long periods, so this remains a strong positive signal. However, as we discussed earlier, some of that growth was supported by non-core income. Now, let's talk about cash flow, because profits can sometimes be manipulated and influenced by accounting assumptions. Cash is harder to manipulate. Operating cash flow measures the actual cash generated from business operations. Here's what happened. It was 30.6 billion naira in Q1 2025 and 679.3 billion naira in Q1 2026. That's an enormous increase. At first glance, this appears extraordinary, and it is. But there's an important detail. A significant reduction in receivables helped release cash into the business during the quarter. Receivables represent money owed to the company by customers. When receivables decline, cash comes in. So the cash flow is absolutely real. But not all of it came from current quarter profitability. Some of it came from working capital improvements. That's an important distinction sophisticated investors should understand. Now, let's move to the balance sheet. The balance sheet tells us what the company owns, what it owes, and what ultimately belongs to shareholders. Here are the key figures. Total assets costed 9.06 trillion naira. Total equity amounted to 1.89 trillion naira. Cash and cash equivalents was 1.60 trillion naira. Equity represents the shareholders' ownership interest in the business after liabilities have been deducted. In simple terms, it is what belongs to shareholders. The balance sheet remains very strong. Cash balances are substantial, assets continue to grow, and debt appears manageable relative to the company's asset base.
Now let's talk about dividends. For many Nigerian investors, this is where things get exciting. Aradel paid a dividend of 33 rupees per share. Dividend per share, often called DPS, represents the cash distribution received by shareholders. Let's compare that dividend with earnings. EPS equals 173 rupees and 62 cents. DPS equals 33 rupees. Payout ratio is approximately 19%. The payout ratio measures how much of a company's profits are distributed as dividends. At only 19%, Aradel retains most of its earnings while still rewarding shareholders. This makes the dividend extremely safe. It also creates room for future dividend growth. Let's talk briefly about net asset value, often called NAV. Net asset value is what shareholders would theoretically own if the company sold all its assets, paid all its liabilities, and distributed the remaining value to shareholders. Net asset value per share increased significantly from approximately 343 rupees to about 436 rupees. That's another sign of value creation. Shareholder wealth continued to grow significantly during the quarter. Now let's discuss management. Are they creating value for shareholders? The evidence says yes. Revenue is growing. EPS is growing. Net asset value is growing. Dividends are growing. And importantly, there is no evidence of dilution. Dilution occurs when a company issues additional shares, reducing the ownership percentage of existing shareholders. Aradel has avoided that. So if the business is doing so well, why isn't this an outright buy? The answer lies in valuation. Valuation is what separates a great business from a great investment. At 1,750 rupees per share, Aradel currently trades at roughly 4 times its net asset value. Using annualized first quarter earnings, the stock trades at roughly 28.7 times earnings. And once we adjust for the contribution of non-core income, the valuation picture becomes more demanding. If normalized earnings are materially lower than reported earnings, Aradel's normalized price-to-earnings ratio could exceed 40 times earnings. That would make it one of the more expensive stocks on the Nigerian Exchange. And that's really the heart of this investment debate. The business itself remains exceptional, but investors may already be paying a premium price for that quality. And that brings us to the key red flags investors should monitor. Heavy reliance on other income. Cost growth exceeding revenue growth. Gross margin compression. Premium valuation. Acquisition integration risk.
and continued exposure to oil and gas prices. On the positive side, the green flags remain impressive. Revenue growth of 264%, EPS growth of 96%, strong cash generation, rising NAV per share, no dilution, a conservative dividend payout ratio, and successful strategic asset expansion. When we score the company across the major categories, Aradel achieves an overall score of 70 out of 80. That's an exceptional score. But here's the important distinction. An exceptional company does not automatically mean an exceptional stock, at least not at every price. For existing shareholders, the long-term story remains attractive. The business continues to create value. For new investors, patience may be the better strategy. A more attractive entry point could significantly improve future returns. So what's the final verdict? Aradel remains a high-quality energy company creating shareholder value through rising EPS, rising NAV, and growing dividends. However, the first quarter of 2026 also revealed margin pressure, heavy reliance on other income, and a valuation that appears demanding once earnings are normalized. For that reason, the rating remains hold rather than accumulate at the current share price of Naira $1,750. Before we wrap up, remember that this video is for educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Now, I'd like to hear from you. Do you think Aradel deserves its premium valuation? Or do you think the market has become too optimistic? Let me know in the comments. And if you enjoyed this breakdown, subscribe to Behind the Numbers TV, because every number tells a story. And together, we'll learn how to read it.